Welcome back. If you're tuning in, you're likely an active investor, someone trying to, well, make sense of these markets.
Yeah, navigating the noise, right.
Exactly. And today, we're going to dive deep into the latest Art of the Trade newsletter from the Macro Butler.
Oh, I always enjoy their stuff. It's sharp, insightful, but doesn't take itself too seriously, which is refreshing. Not your typical dry analysis.
Absolutely. So our mission really is to unpack the key takeaways from this issue, figure out what's relevant for your investments, and sort of separate the signal from the static.
Sounds like a plan. Where do they kick things off?
Well, interestingly, they start with trading itself. They call it performance art with a touch of masochism.
Slight laugh. That sounds about right. I mean, it does capture that psychological side, doesn't it? It's not just crunching numbers.
No, it's the discipline, the pressure. Even when you're right, it can be a grind. It really highlights that emotional element.
Yeah, the human factor. It's easy to forget that.
Then they pivot to international trade, comparing it to poker with tariffs.
Okay, I like that analogy. Poker implies strategy, bluffing. It's not just pure economics.
Right. They touch on Ricardo's comparative advantage, the classic theory,
Sure, the idea that countries should specialize in what they do best.
But the newsletter argues the modern system, especially with the U.S. dollar's dominance, has kind of moved way beyond that simple model.
Ah, the reserve currency status. That changes the whole game. They mention imperial privilege?
They do. Explain that a bit. What does that mean in practice?
Well, basically, because the world needs dollars for trade and reserves, the U.S. can run persistent trade deficits. It just issues more dollar assets bonds, mostly to foreigners.
So like printing IOUs that the rest of the world accepts because they need the dollars anyway?
Pretty much. It's a unique position. But the newsletter also hints, that other countries aren't just sitting back. They're using subsidies, currency tactics, tax loopholes, trying to game the system, so to speak.
Playing their own hands in this poker game. Okay, so let's get into the specifics. These Liberation Day tariffs, unveiled April 2nd, 2025. The newsletter uses a funny example. Bananas and apples.
Yeah, they simplify the formula, basically. U.S. trade deficit divided by total imports to show how, theoretically, you could end up taxing imports from countries that barely run a surplus with the U.S., like penguins, as they joke.
So it highlights how blunt the instrument might be.
They're very blunt and potentially counterproductive, which leads into their point about the Triffin paradox.
Right, the Triffin paradox. Remind us why that's so critical here.
It's this fundamental conflict. The world needs the U.S. to supply dollars, which means the U.S. has to run a deficit. But running massive, persistent deficits can eventually undermine confidence in the dollar itself.
So tariffs aimed at reducing the deficit too aggressively could actually backfire.
Potentially, yes. It could disrupt the global flow of dollars and shake confidence in its reserve status. The newsletter argues these imbalances aren't always a bug. Sometimes they're a feature, reflecting different wage levels or development stages.
They mentioned Treasury Secretary Besson's comment. Let them eat flat screens.
Yeah, the idea being cheap imports are good for consumers. But the newsletter pushes back, saying aggressive tariffs create uncertainty.
Which scares off investors.
Precisely. Businesses need predictability. Constant trade wars aren't exactly conducive to long-term investment. That fear could actually hurt the economy more than the tariffs supposedly help.
Okay, let's switch to economic history for a moment. The newsletter tackles a big one. The Smoot-Hawley tariff and the Great Depression. They call the connection a fairy tale.
Yeah, they argue it's just bad history, basically, a common misconception.
Why? What's their take?
Well, first, Smoot-Hawley mostly targeted agriculture. It wasn't the first big U.S. tariff act either. There were others earlier in the 1920s.
Like the Fordney-McCumber tariff.
Exactly, part of a broader post-WWI isolationist trend. But more importantly, the newsletter points to something often overlooked. The massive wave of global sovereign debt defaults in 1931.
Ah, so that was the bigger shock to the system.
That's their argument. They say even famous accounts like Galbraith's The Great Crash kind of miss the significance of those defaults. The timing is crucial, too.
Right, you mentioned the market fell before Smoot-Hawley passed.
Significantly before June 1930, yes. The newsletter suggests other things were happening, like UK elections, a big Ford deal with the Soviet Union that impacted markets, and globally, many countries had already been raising tariffs before the U.S. did.
So Smoot-Hawley was part of a trend, not the sole cause.
Yes. And the newsletter suggests blaming Smoot-Hawley became a convenient political narrative later on, maybe for the Democrats in '32, kind of like how trickle-down economics became a political punching bag.
So the real crisis trigger, according to this view, was more financial. The European debt crisis kicking off with the Creditanstalt bank failure in Austria in 31.
That's the core argument. The sovereign defaults were the real phase transition, as they put it, not the tariffs themselves.
Interesting perspective. Bringing it back to today, they mention how political winds shift, noting even Nancy Pelosi once supported tariffs against China.
Yeah, back in '96. It just shows how these things can be framed differently depending on the political climate. It underscores the political motivations that might be at play now.
And they connect this to the balance of payments, current account versus capital account.
Right. The current account is mostly the trade deficit. The capital account tracks foreign investment coming in. Usually, the capital account surplus finances the current account deficit.
But tariffs could mess that up.
The worry is that tariffs, by creating uncertainty and potentially slowing trade, could scare away that foreign investment. So you might shrink the trade deficit, but you also shrink the capital surplus funding it. Not necessarily a win.
They also make a point about why U.S. companies might be relocating production. It's not just about cheap labor overseas.
No, they argue the overall U.S. tax burden, state and federal combined, is a huge factor, pushing companies to look elsewhere, even to other states within the U.S. with lower taxes. Tariffs, in this view, just add another layer of cost.
Essentially a hidden tax.
On consumers and businesses, yeah.
So which sectors do they see getting hit hardest by these new Liberation Day tariffs?
They pinpoint tech, media, telecom, chemicals, and textiles. But interestingly, they flag mid-cap stocks as potentially more vulnerable.
Mid-caps. Why them specifically?
Higher reliance on imported components, maybe? And more concentrated revenue from specific foreign markets like Canada, Germany, France, which could be directly impacted. Plus, they note active managers seem to be shifting focus towards mid-caps anyway.
So more exposure and maybe more active selling if things get rough.
Could be. But again, the main thrust of the newsletter is don't panic solely because of tariffs. They don't cause depressions.
What does cause them, in their view?
Sovereign debt defaults. That's the real systemic risk to watch.
Okay, so given this whole picture, how does the art of the trade suggest investors position themselves? They use that art of war analogy.
Right. Know yourself, know your enemy, or in this case, know the market environment. And their outlook is for an inflationary bust.
An inflationary bust. So prioritize capital preservation.
Exactly. Focus on return of capital, not just return on capital. Preserve what you have.
And their specific advice leans heavily towards
Physical gold and silver. They call them anti-fragile assets, no counterparty risk. A hedge against government actions, central bank policies, that sort of thing.
what else?
Hold other commodities, too, to ride out what they call the commodity leviathan. Manage cash actively short-term, high-quality U.S. dollar bonds, T-bills.
And for stocks.
Favor companies with low debt, strong earnings, good free cash flow, specifically energy and commodity producers over consumer-focused companies. They also mention the S&P 500 to gold ratio as a signal that this bust might be closer than people think.
So defensive positioning, hard assets, stay disciplined.
Very much so. Stay calm, use the data, don't get swept up in the headlines.
They also touch on the bigger geopolitical picture, right? The shift away from U.S. dominance.
Yeah, the move towards a multipolar world, more focus on national self-sufficiency. They see the Russia-China-India bloc gaining influence.
And countries sticking too closely to the old U.S.-centric model might get left behind.
That's the implication. They flag China slowly selling U.S. treasuries and rising yields during Asian trading hours as signs of this shift.
Which circles back to gold again.
As a key refuge in that kind of uncertain geopolitical landscape, their advice is pretty clear. Steer clear of longer-dated government bonds, maybe add some Dow Jones stocks on dips, but prioritize physical gold held outside the banking system.
For true autonomy, as they say. They seem pretty convinced the media panic over tariffs causing a crash is overblown.
Yeah, likely politically motivated noise in their view. The real risks lie elsewhere. Debt, geopolitical shifts.
Okay, so let's try and wrap up this deep dive into the art of the trade.
Yeah.
What are the main things investors should take away?
I think it's about looking deeper. Understand the psychology of markets, the real mechanics of global trade beyond simplistic tariff talk, the historical context, especially around debt crises and the big geopolitical currents.
Don't just react to headlines.
Exactly. And focus on preserving capital through tangible assets like gold and commodities if you believe their outlook of an inflationary bust is plausible. It's about strategy, not just stock picking.
It certainly gives us a lot to chew on. A reminder that mastering the art of the trade today requires more than just financial charts. It's about understanding these big interconnected forces.
Definitely. It's a complex picture out there.
So the provocative thought maybe is, are you prepared for a world where the old rules of trade and finance might be changing rapidly? Maybe reading the full newsletter is a good next step.
Couldn't hurt to get the full context.
Oh, thanks for joining us for this deep dive. Hopefully it's provided some valuable perspective. Until next time, keep thinking critically.